The federal funds rate increases this week, while there's still really a dismal outlook on the economy here in the United States. Plus, it's also forcing the Fed to get more aggressive and have to do it for a longer period of time from what it sounds like. Let's see how that went ahead and affected the bonds market and the stock market and see how it affected the mortgage interest rates this week right after this. Welcome back after the break, everybody. Mike Petras here, your Star Realtor of Star and the Treasure Valley, back with another weekly mortgage update for the week of 9/19 through the 23rd. So what happened this week? Well, really, we do know that the Fed met on Thursday and raised the federal funds rate by 0.75%, and also really kind of said we now have to get aggressive and we have to continue to get more aggressive and maybe even do it for longer. So what does that mean as we kind of trickle down? And does it mean that the Fed is actually going to be able to come in for a soft landing at this point as compared to the effects of the recession generally going to be right around the corner? And how does that really relate with mortgage interest rates as we move forward? So let's go ahead, let's dive into the data. Let's see what's happened this week and let's go ahead and let's discuss it. So what do we know over the last several weeks? We definitely know that a lot of the investors out there have really been putting themselves in defensive positions because of the CPI report that came out last week, and all in anticipation of what the Fed was going to do and the overall stance of our economy according to them. And of course, as we know, the results are still looking dismal, and it still looks like the Fed has not been able to accomplish their goal of anywhere near a soft landing. And what do they basically say on Thursday? They said that they're going to continue to be more aggressive and maybe for longer in order to correct the inflation problem that we have here in the United States. So what was generally happening overall is that people were selling. And ever since the Fed did speak on Thursday, they have been selling and selling even more. And we can see that in the stock markets. We can see that in the bond markets too as well. Now, what really kind of affects, say, mortgage interest rates more than the other, it's not going to be so much the federal funds rate and what they do with that, because we know that affects short-term deals more than it does longer-term deals, like say like the 10-year Treasury note or the 10-year Treasury bond. But regardless, is that even though the FFR did go up, it still kind of ripples its way down and affects investor confidence overall. And we know that when people sell their stuff, that we know that the mortgage interest rates will go up, especially if we're looking at the Uniform Mortgage-Backed Securities, or the UMBS, which is really directly in relation to mortgage interest rates. So again, when people sell and the value goes down, the interest rates you can expect to go up, and then vice versa. When investors come back in and they start buying up, you can actually expect the interest rates to come back down. And ever since then, again, the Fed speech on Thursday, we have noticed that investors have been just kind of jumping out all over the place and selling. So that is really the key of what has happened this week with mortgage interest rates, is that everybody is on a selling trend right now. And we'll just have to see how this goes ahead and filters out as time goes on. So let's start off with the UMBS 30-year, and we can see that the coupon actually changed to 5.0 because the value actually dumped out of the range of a 4.5 coupon. And we can see from this trend, boom, we have just been going down. Really, since Thursday, a lot of again, investor confidence got rocked. So let's go ahead and let's take a look at what happened over here throughout the course of this week. And really, we can just see that the UMBS has been taking hit after hit. And again, as we know, as the value of these, the value goes down of the UMBS, we do know that interest rates go up. And we can see starting off on the 19th, lost a quarter point, then lost another 0.14%. or 14 basis points. Little bit of relief on Wednesday, but then Jerome Powell spoke. And when he spoke, bam, just down 1.13. So over a full point loss in the overall value of the UMBS. And then today we've lost 0.09 of a point, again, increasing the rate. So I'll get to where everything kind of stands here in just a second over all of them. But the 15 years today also went back into the 5.0 coupon over the week. And we can see today that it actually went up 0.17 basis points, which is good. Because again, we know when the value goes up, the price of like the 15-year is going to go down on the mortgage interest rates. But overall for the week, again, just kind of took its hits. On the 19th, we can see it went down 0.27, so a little bit over a quarter. It went a little bit, ticked back up the other direction on Tuesday. Wednesday came back down 0.09 of a point again. And then Jerome Powell spoke. The Fed made their decision with the federal funds rate, and we can see that it almost went down a full point. And then today, a little bit of relief when it comes to the 15-year. So let's go ahead and let's see where everything stands right now. Honestly, they have gone way up, okay, since, say, last week. Overall, if we're looking at a 30-year fixed right now, we're looking at 6.70% for your mortgage. Over the day, it went up 0.8%. But over the week, we can see it went up 0.35%. And over the month, we're up almost a full point. Over the year, however, the 30-year fix has definitely jumped up a lot, and we all know that at 3.60. The 15-year fixed right now is sitting at 6%, basically unchanged on the day, but over the week, what also went up 0.35%, and over the month, almost again up a full point. The 30-year FHA is sitting at 6.25% this week, up today by 0.505%. Over the week, up a half a point. And then over the month, up 1.13%. The 30-year jumbo today is sitting at 5.95%, basically unchanged for the day, but up 0.25% over the week and up 1.05% on the month. The 5-year 5-in-1 ARM is sitting at 6.12. I wish 1 point. That'd be great. 6.12% unchanged for today, unchanged on the week, but up over the month, just shy of 0.25%. And then for the 30-year VA, we're sitting at 6.25%, up 0.01 or 0.1 of a percentage point today, up 0.40 on the week, and for the month, up 1.11%. So let's briefly dive into the Treasury yield or the Treasury yields. And we'll go ahead and we'll start off with the 10-year Treasury note here. As we know, again, the same kind of a principle applies. That is, people come in and start buying up these bonds, we can actually see that the yields will go down. And today, the yields are actually sitting at 3.687%. Which was actually down a little bit today because people came in and started buying up this particular Treasury, and which is good because the 10-year Treasury yield and the UMBS really kind of, even though they're separate, they do correlate with one another. So when the Treasury yield goes down, we can expect mortgage rates to actually go down with them. But when they are on the rise, we can actually expect the mortgage interest rates to be on the rise with the 10-year Treasury note. And if we're taking a look here, especially when we hit Thursday, there was a big sell-off here in the 10-year Treasury yield or the 10-year Treasury note, which brought down the price, which raised up the yield. So inversely, what did that do to the UMBS? It also raised up mortgage interest rates to the levels that we're at today. Today, though, which is kind of good, you can see that the price change happened overall. People are coming in, buying this up a little bit more, maybe because of what's happening in the stock markets overall and that people are just losing in the stocks. So what happens when they lose in the stocks? They generally run to the bond market, which can be good for mortgage interest rates overall. But this week, everything started taking hits. We know that since the beginning of this video had started. But good news a little bit for the 10-year Treasury note today is that the price went up a bit, which brought down those yields. And we kind of saw a little bit of that change today as it came over into the UMBS. So let's go over to the 2-year Treasury yield. Now, the 2-year Treasury is actually more affected by the federal funds rate increase that happened on Thursday because it's considered more of a short-term deal. That is the power that the Federal Reserve basically has. And we know right now that the 2-year Treasury note to the 10-year Treasury note is inverted. And when it's inverted, it usually screams out recession. So do we see a recession and the effects of recession coming up? Absolutely, I do. It's just going to be a matter of time before it does hit. And what do we know that happens with mortgage interest rates when a recession does hit? We do know that the mortgage interest rates historically will come back down because the Fed needs to loosen their policy in order to stimulate the economy. But over this week, I mean, the 2-year Treasury note, it has just been kind of losing, a lot of people dumping out of it. And you can see that the actual Treasury, the yield itself has been on a rapid rise. In fact, it's at 4. So it's above 4.203% if you're looking at it today. So what are a lot of investors thinking right now? Do they want to invest in a 10-year Treasury yield, which is only getting them 3.6, or do they want to still invest in the 4.2? Of course, they're going to want to invest in and get a better yield overall. So that is what the Fed is trying to correct, to put us more on a normal slope and get us back to where it's more advantageous to invest in a 10-year Treasury yield as it is in a 2-year. And right now, the 2-year is definitely eclipsing. But we can see that the sell-off is still happening here in the price change, and we can see that the yields on the 2-year Treasury note have been on the way up. And especially if we're looking back, on Thursday when the Fed chair did speak, we can see, boom, there's a lot of sell-off, because usually what happens with bonds too is that when the federal funds rate goes up, a lot of people start selling out. And what does that do to the yields? It raises them up. So now, just very briefly, I just want to go through and show what happened in the stock markets overall this week. Ever since really Thursday, we've seen some really big hits happening here again in the stock markets. And usually when people do start losing in the stock markets, they do generally run to the bond market. So that could be a good thing, for mortgage interest rates overall. We'll just have to go ahead and wait and see. But again, people's confidence in the bond market, stock market, UMBS, etc., their confidence is rocked, because they do know that the Fed has to get aggressive and they have to do it for longer, and then inflation is still an issue. So as long as that's going to be the deal, we can expect to see hits coming across the Dow Jones, NASDAQ, bond market, S&P, you name it. So we're just going to have to keep watching in tune. But this week, definitely the Fed really rattled that. Have I made that point really clear over these? But over this week, it basically lost another 1,000 points, just a little over 1,000 points, 3.69% on the Dow Jones. If we're looking at the NASDAQ, same trend. NASDAQ went down 470 points, down 4.15% over the last 5 days. And then lastly, if we're looking at the S&P 500, it's gone down 156.68 points, which is down 4%. So again, hits just happening all over. People are selling off their stuff. So we're just going to have to continue to monitor and see what happens. But in the end, interest rates are definitely on the way up. They definitely eclipsed what we had last week, and I can anticipate them to continue to rise until this kind of generally irons itself out. And right now, I just don't see where it's anywhere near it at the moment. But again, is it a bad time to buy? Let's go ahead. Let's talk about that in my final thoughts. Well, thank you very much, everybody, for taking the time to watch that video. I do hope that you found the information useful. But let's go ahead and let's tackle the big, giant question that has been looming. Is this a bad time to buy? And really, the answer to that question is no. And why is that the case? Because really, we are in a buyer's market right now. So what does that mean? That means for you buyers that are out there, there is a lot of inventory to be able to choose from. That means that you'll be able to find the home of your dreams with really no fight that's going to come along with it. There's also been price reductions happening all over active listings across the Treasure Valley in record numbers. Plus, on top of that, we can probably go ahead and negotiate to be able to maybe even save you some more money. But what has also returned to the market is seller's concessions because of the buyer's market. So what is a seller's concession? That's either giving you money for closing costs, or maybe you can go ahead and take that money and buy down your rate with it. Whatever it is you really decide to do, because sellers now are really kind of in the position to where they're offering seller concessions in order to be able to sell their home to you. So that's a win-win-win across the board. Now, interest rates, yes, are they high? They definitely are. And you're probably going to end up feeling that pinch until today, if you were to buy, or say even a month from now, to the point where the effects of a recession hit. Is the recession here? Absolutely. 2 negative quarters of GDP. Unemployment's under 4%. Inflation's above 4%. Doesn't look like the Fed can get a handle on it either to be able to create the soft landing that they kept talking about. So are the effects of the recession eventually going to hit? Yes, they are. And what happens when a recession hits historically? That mortgage rates will have to come back down because the Fed will be forced to loosen their policies that they have going on. So if you will end up feeling the pain, when you're talking about, from the time that you end up buying until the effects of the recession happen and the Fed has to loosen their monetary policy and come back down, like in their federal funds rate, etc., and promote growth in this economy. So, but between that time, you not only did you get the house of your dreams, you got it maybe with closing costs picked up, got it for even cheaper because of the price reductions that are happening in this buyer's market, but then you'll be able to go ahead and refinance for free to practically very little of anything at all. So it is a win-win-win situation. Right around the corner. We're just gonna have to wait and see how long it's going to be until the effects of the recession actually hit. And if I was a betting man, I would say sometime after the midterms, maybe up until Q2 of 2023. So again, we'll just have to wait and see. Well, thanks again, everybody, very much. If you are looking to buy, sell, or invest in real estate right here in the Treasure Valley, feel free to reach out to me today. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your home shopping experience today, please visit my website at www.yourstarrealtor.com. Also, if you're looking to move in from out of state right here to the Treasure Valley, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, please hit that subscribe button below, hit the notification bell, and comment, please. I'd love to hear what your thoughts are on the state of our economy and what you think is going to happen in the real estate market, say right here in the Treasure Valley or even across the U.S. I'm also going to go ahead and post a couple of videos to Mikey's monthly market updates, which covers what's happening right here in Ada and Canyon counties over the last month, which was August. So if you'd like to be in tune with what happened in the real estate market right here in the Treasure Valley, please watch that video. And also, if you'd like a more in-depth analysis, I'll also include at the end of this video the Fed's meeting that happened on Thursday so that you can get a full breakdown of what to expect from here. So thank you again very much, everybody. I look forward to the day we speak. I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.